Welcome to our live chat, everyone. I'm Dennis Stearns, joined today by other members of our investment committee, John Thomas, Glenn Joyce, and PJ Williams. We have a lot to talk about. There's been a lot going on just in the last week. Plus, we are going to dig a little deeper into what we talked about in our written chat a week ago around international stocks versus US stocks, valuations, returns going forward, that sort of thing. So let's get right into it. So, JT, you want to tell us what we're looking at here?
Be glad to. So thanks, everyone. Appreciate the opportunity to share a little bit more of our thinking with you. We're going to lead off with a bit of a reprise from what we did in our written chat last week, which is to focus on international stocks. Obviously, international stocks has continued to be a bit of a sore thumb in portfolio returns this year. They most recently outperformed U.S. stocks in 2017. But if you go back over the last decade, we've seen the longest stretch of U.S. outperformance over international on a relative basis that's on record. So a valid question continues to be, what's the place of international stocks in portfolios? We still feel like the basic principle of diversification warrants their inclusion, but we wanted to focus on some of the long-term view and remind ourselves what is the predictions around future returns from international stocks that would support their inclusion. So first off, we're actually here looking at U.S. stocks, specifically large cap U.S. stocks, and PJ will provide a little bit more context around where the returns are coming from in U.S. stocks. But this is a very long-term view going all the way back to before the Great Depression, and it shows the volatility in blue of the stock return around its long-term trend line. So you can see, though, there are extremes driven by fear and greed that sometimes take the returns well above or below that long-term trend. It is not necessarily predictive in the short term, in a 6 months to 1 year period, but over a 3 to 5 year frame, when you get well outside or well on either side of that long-term trend line, it tends to revert. It tends to come back to trend. So right now we're not dramatically above, but we are roughly 17% above that long-term trend if you think about returns on U.S. stocks. So that starting point matters, as we'll talk about in a little bit. So again, U.S. stocks not dramatically expensive, but not cheap by a very long-term predictive measure.
So we can two pieces. Let's go back to that prior one for a second. Two pieces to keep in mind. This is a real return index. So when you see that 6.4% trend, that is after inflation. So if inflation's been high and low over this period of time, but if you added, say, 3%, that's where you get 10% expected returns in U.S. stocks over time for the trend line. The other thing to keep in mind, and Glenn will be hitting on this towards the end of this chat, is 1999 comparisons to today. There have been a lot more of those here recently, and you will note the big spike up in that blue in 1999, and so we're not exactly spiking at that level today.
Really good point to remember about inflation, and I think the other takeaway from a slide like this is, the market has this average return, but you have long stretches of secular periods where it can either be from well below going to well above, as from the early 80s to the late 90s, or you can also have periods of so-called secular stagnation, as you had from, say, the mid 60s to early 80s, and perhaps again from the late 90s until the financial crisis of 08, 09. So very instructive chart, important to keep inflation in mind, but likely to come back towards that long-term trend. So let's compare that to the next slide, which is the international, the Europe, Asia, Far East index. Shorter slice of time. We don't have accurate index history going back nearly as far outside the US, but pretty dramatic. So you'll see the same trend. You'll see a lot of the same movement at the same time, but look over the last 10 years, where international stocks have been persistently well below their long-term trend line. At this point, a pretty dramatic 47% below that long-term trend. So again, this doesn't tell us when that is going to change, when the tide's going to turn and the relative performance will shift, but it does suggest that over a sufficient timetable, we're likely to see a return toward trend, which would be an outperformance of international stocks. So international stocks are profoundly cheap by this and many other measures promulgated by a lot of research sources that we respect. Okay, we can move to the next one. So this is another presentation of that. This is the forward price to earnings ratio. So the last one was looking at that long-term trend. This is just looking at current stock prices divided by the expected earnings. And here again, you can see a pretty dramatic difference. It's grown over the last 10 years, but consistently US stocks in red have had a higher valuation. They've been more expensive relative to their future earnings or future intrinsic value than have international stocks. Things get really choppy at the end of this chart. The meltdown that occurred in March related to COVID, followed by some recovery, has created a bit of a more seismic chart here, but that will even out. And I think the big takeaway is, international stocks are again 20 to 40% cheaper on a relative basis than US stocks are. So again, not a timely indicator, but one that should hold a lot of value over a 3 to 5 year window. Okay. So this distills that across a number of asset classes. This is from one of our favorite research sources, Bank Credit Analyst. Here you can see a range of different categories from top to bottom, moving from the broad global equities, fixed income, and cash into various regional markets, and then comparing their outlook, sort of a stoplight chart on 3-month, 12-month, or 10-year intervals. So clearly red is less favorable. Fixed income across the globe stands out as being less favorable over all those time frames. Obviously, with interest rates as low as they are, it's going to be hard to eke out real return in that category. But what's interesting in the bottom half, if you look across a range of different geographies in their equity markets, in the short term, they're all fairly similar. Over 12 months, the international stands out relative to US, and over a very long time frame, actually international more favorable than US, but particularly emerging markets. So this is a way to synthesize kind of the weight of the evidence, both valuation and a lot of other factors. Currencies obviously come into play, but again, this is a good portrayal of one of the differences we see that would say perhaps being a bit underweight US and overweight international over that 12-month to long-term time frame. Okay. I might note in most portfolios, we're currently still at or a little bit underweight international allocations, not materially overweight. Our current thinking is that we would gradually kind of continue to tiptoe or wade into international stocks to perhaps become overweight to those over another, say, 1 to 2 years. But obviously we'll be evaluating that as we go. So this one is a little more complicated, but what you're looking at here is the correlation between how far are you from trend. So those first 2 charts we looked at that showed the US about 17% over trend, international well below trend. This shows from that starting point, what are the returns over the next 10 years? So if you move from left to right, you're going from undervalued to overvalued. And if you look at the slope of that correlation line, what you'll see is if your starting point is well below the trend, as international is, the returns achieved over the trailing 10 years, the next 10 years, have been quite good. So real returns, if you're 40% undervalued, this is US data, but the average return over the next 10 years would be between 10 and 15%. Conversely, if you're 20% over trend, you can see that the center of that would be a real return of only about 5%. Again, this is US data, but I think it's also instructive. The international looks fairly similar. So again, starting point matters. If you start from overvalued conditions, your expected real returns are bound to be lower than if you start from undervalued conditions. So all of this supports the idea that with a cheaper price, you want to be averaging into those cheaper categories, which to us are still international stocks despite recent performance. So that's a summary of the international data. Any other comments from other members of the panel today?
Yeah, particularly about emerging markets, because that was one on the previous slide that was one of the few ones that scored a 5 at the highest level. But I know there's been a lot of debate about emerging markets of late.
What I would say about emerging markets really is, looking at that long-term trend, definite tailwinds will be demographics. And we've talked about this before, where you see demographic trends of a working age population that's growing is able to support a more robust economy. So you're seeing that on the continent of Africa, you're seeing that in Southeast Asia, in Europe, and somewhat in the US and other developed nations, Japan especially, their demographic trends don't look the same. And so as a result of that, we see more potential for productivity growth and economic growth in those regions. But the headwinds that they're facing, and certain ones that are facing this more than others, are they have significant debt loads, like you're seeing in many parts of the world. But if their debt load is in not their own currency, because not many of those countries can issue debt like the US can in its own currency, well, if they borrow in US dollars, and right now the US dollar is expensive, well, that weighs on the overall economy there. As the US dollar strengthens and they're having to pay interest on that. So I think in the near term, you have positive demographic trends, positive productivity growth, and growing economies, but they do have face headwinds of being more cyclical in nature, depending on where that revenue source comes from for their economy, and also with their debt loads in certain regions. So they're going to need to clean up some of that government fiscal balance sheet to really achieve what they're looking to in terms of robust growth, which would hopefully, for the local stocks and local companies, translate into increased revenue, increased profitability, where in BCA's view, that long-term, really positive view on emerging markets could actually play out.
I'll just maybe add a couple more comments. I think, the big question obviously is, when do you start fading the US, which has obviously been the strong performer here on a relative basis, and start maybe leaning in more to international? And candidly, we've been doing that some over the past several years and kind of tapped the brakes because, we have our strategic allocation, which is kind of the baseline allocation when we look at how much we want to have in US stocks, international stocks, et cetera. And we've been getting a little closer to our target on international, even a little more underweight on the US, but still much more in the US when you look at it more in the aggregate. So I think, going forward, we see some signs that this is eventually going to play out. We just don't know when. And so I think that is the key decision when you start looking forward, is when do you think the internationals will start showing its true valuation, earnings potential, and just kind of at what point does it make sense? And that's the big challenge right now, is the U.S. has still been the great place to be. So I think the U.S. dollar could play into that, and we're looking at that as well, because the dollar tends to be a little countercyclical at times, which means when the economy improves, the dollar may weaken, but that's not always guaranteed for sure. So definitely a big factor in going forward our decision matrix.
Of course, you have to overlay all of that with the current health and economic situation, where obviously the U.S. is still struggling a bit to address the case counts, as we'll talk about momentarily, where some parts of the rest of the world are coming out of it a little bit more robustly. So with that, why don't we shift to the medical innovations going on to try to address the recovery from the virus.
So we've had a number of questions from clients about vaccines and treatments, and when will this all be over? But the Operation Warp Speed U.S. government program is an important part of everything that's going on. So this quote is from Health and Human Services Secretary Alex Azar, and this was from this week, talking about the scale of what they're doing to make vaccines, to enable those vaccines to be made, using essentially the full power of the US government and financial resources to do that. Now, there's been a little bit of discussion about his comment. We're not concerned about the supply chain. That's really left up to many of the pharma and biotech companies to work out, and whether some of that supply chain ties into China, which again, many of our healthcare professionals in our network have expressed their concern about that and what we've seen during the pandemic. But again, I think much of this suggests that Operation Warp Speed is something to keep a close eye on. Let's go to the next slide. So the amounts that are being put in, normally we would say they're huge, but in this world where we're doing $1 trillion stimulus packages, I guess they're not so big at all. And so essentially this week, the government took what is effectively an option on 100 million doses of vaccine that is being developed by Pfizer and BioNTech. And at 100 million, they would be willing to pay, or they're offering to pay 1.95 billion for that if it's approved according to the FDA gold standard. And this is under the emergency fast track FDA system. And so that 1.95 billion for 100 million doses, they have also optioned another 500 million doses. And they have additional possibilities for beyond that. So the 6 entities that you see on the screen have all been optioned for those amounts of money. And so what we could very well end up with, and several of our infectious disease folks in our network just in the last couple of days have texted me that we could very easily end up with 3 of these that are viable and that are being administered to Americans, free of charge, by the way. And so that then brings up the interesting issue. And again, we've had a number of clients say, well, I'm not sure I want to be the first one to get that vaccine. I want to see how the side effects work out. But then the question is, which vaccine do you end up taking? And so there's a lot of really interesting things that could be happening in the next 6 months. And they actually believe that some of these will be in a position to distribute out by late 2020, in some cases early 2021. Now, again, some of our research experts in our network have been saying this week, well, it seems like that's a little ambitious. But let's go to the next slide. Here is the CEO of Pfizer leaning in on this issue this week and basically saying it's not all about the government here. We've actually been working in record time to produce this safe and effective vaccine, and they made the early decision to begin clinical work and large-scale manufacturing at their own risk. So again, it was a bit of an interesting juxtaposition this week of who is allowing who to do what. Is this being driven by pharma, knowing the government might help pay them, or is it being driven by the US government? And the other interesting piece to all this is that this emergency use authorization, that's the last sentence that he talks about, is really part of the fast track process here, in addition to what the FDA is doing. Okay, so let's go to the next slide. So PJ, here's some of the latest COVID trends. Why don't you make sense of this for our audience?
So over the past couple months, we've been showing various versions of these charts that are tracking daily testing, daily cases, hospitalizations, and deaths across America. And on the far left, you've seen obviously the daily tests. We got started off a little slowly in terms of our testing ability, but we have been ramping it up in the last month. Unfortunately, what we're seeing though is a backlog now at this point, so it is taking a little bit longer to get the tests back. So again, we're hoping that between improved supply chains and improved technology, really through innovation, that we'll be able to get testing back under control in terms of shortening the time frame for people getting their results back. What we saw with increasing testing was, not surprisingly, increase in daily cases. One reason for that is the fact that as we test more, we're testing probably more asymptomatic people, So you're just discovering more cases out there in the population through the increase in testing. The hope was that we would not then see an increase in hospitalizations, hoping that, okay, we're just testing more people, testing younger people, testing asymptomatic people, that the hospitalization increase wouldn't happen. And unfortunately, over really the past couple of weeks, as economies, local economies across the country reopen, we have seen the hospitalizations tick back up. And most recently, we've seen the deaths kind of trough and begin to trend up. We all hope that this is temporary and that maybe this is just a head fake on the death side of this, and that we can get it under control and we don't see it back to the levels of where it was during April. But really what we've been saying at Stearns is this is what we want to focus on, because we can see how it's affecting the economy when you think about municipalities, states utilizing this data in many cases to then make decisions on what they're going to do in terms of their reopening plans. And so as we've seen the hospitalizations tick back up and the deaths unfortunately begin to tick up, you've seen many states across the country pause or even take a step back on their reopening plans. And so again, as we go forward in the next couple of weeks, and we said this 2 weeks ago, it's a key juncture to be watching what happens in terms of this data set, because it really is what's being used to make decisions that are affecting the economies. We did see this week an uptick in unemployment claims for the first time in a number of months. And so again, that could be a result of states taking a step back, reclosing certain things, putting more restrictions back in place. So again, this is the data we'll continue to be looking at, because we do think it definitely has a direct effect on what the economy is going to do at definitely the local and state level.
Yeah, thank you. And we were hoping to have an update on the sausage making going on in Washington right now on the new stimulus package. There still seems to be a lot of distinctions between the plans that have been presented. One of the hot items is what PJ alluded to, and that is how much is given out in unemployment from the federal government viewpoint. So just a reminder, it was $600 a week as a supplement. There's one proposal that go down radically, $100 a week effectively, or even less. Another proposal that would go down a little bit less. So, and some small business has driven some of this, saying that some of their workers don't want to come back to work because they're getting paid more through unemployment insurance than they were through work. So there's just a lot of back and forth going on right now. Maybe by next week we'll have a resolution of that. Let's go to the next slide. All right, PJ, what are we looking at here, and how does it tie into some of the stuff that JT talked about at the beginning?
Yeah, so what we're looking at here is really looking at breaking the S&P up into two components. You have the top 5 companies, the largest 5 companies by market cap, which would be Apple, Microsoft, Alphabet or Google, Amazon, and Facebook, and then comparing it to the other 495 companies in the S&P 500. And so, as JT alluded to, we've seen the U.S. pull away and have very strong returns over the past couple of years. This is looking at the past 5 years in this chart. But really what has been driving that, and you can see clearly on the left, it has not been driven by a broad, robust growth across the entire S&P in terms of positive stock performance. It's been driven by those top 5 names pulling the S&P along. So on the left side, what you see is that since the beginning of 2015, those largest 5 names are up almost 300% over a 5-year period. What you see on the green line that's more flattish is you're seeing the other 495 companies are up just over 20% over that period of time. And so just that wide gap, you can see what is going on in terms of, what is really driving the U.S. stock market. Again, it's not broad growth across all sectors, across all companies. It's really concentrated in those 5 names. And we talked about this probably a month or two ago. Another reason that the U.S. has been outperforming Europe and Japan and other areas is that the composition of their indices is not driven and is not as heavy in tech. And so as a result of that, and that's just how their economies are built and what sectors they're focused on. And the last 5 years, we all know that across the globe, the tech companies for various reasons, have been driving growth. On the right side, it just puts in gives you a little bit different picture of that same data on the left. The top 5 companies by market value are 3 times the size of the other 495 companies when you're just looking at the market cap of these companies. So again, it just goes to show you what is driving the overall U.S. stock performance, and just how large and how really how strong the growth has been for those companies. Now, we've talked about in recent weeks, has the growth for a few of those companies gotten ahead of itself? And that is what we'll be looking at over the coming years. Is yes, all 5 are great, companies in terms of, you look at the balance sheet, it's in pretty decent shape when you're looking at an Apple and a Microsoft especially, and they've had strong earnings growth. But can they maintain that trend to then catch up to where the price is trading for a couple of these companies? And so that's definitely something we'll be watching over the coming years.
And it's interesting to note that right about when these charts started, many of our audience will remember were when we started talking about the techno-industrial revolution and the deployment stage of that revolution, which these techno-industrial revolutions, they tend to start with a frenzy stage where things get crazy. Then they go into a bust stage. So frenzy could be 1999. They go into a bust stage, then they go into a deployment stage, which can last for decades and be very profitable. So while we believe in this process and have leaned into it, these numbers that PJ just went over are off the charts. So again, that's another issue that we're talking about on a regular basis, is where do we go from here, rebalancing some of this holdings within our portfolio. So we then get to another frequently asked question, and it was actually a question that none other than billionaire Mark Cuban brought up at the beginning of this week. Are we in 1999? Now, he didn't actually ask it as a question. He stated it as a fact. And so, Glenn, walk us through the differences between 1999 and where we are today.
Sure, Dennis. Yeah, I think it's hard to believe it's been over 20 years now. It seems like it wasn't that long ago. And you hear a lot of talk about the similarities given where we are with the market cycle and just the pretty good stock returns we've had. But here are some differences. And really, if you think back to 99, we were in an era where we thought it was a new era. We thought this was going to be something where the internet and just there was a new economy, right? And so things were extrapolated at probably unsustainable rates. Not thought so at that time as much, but definitely there was a lot of frenzy and excitement, exuberance around technology. You saw just a lot of people extrapolating growth rate out, and supply was somewhat insatiable, at least in the view of a lot of analysts. And so we just saw a lot of, the telecom and the technology sector was really leading the charge, especially here in the US. And it got into extreme valuations, and people started just really thinking that if you weren't getting mid-teen returns, you were doing something wrong. And it was expected for that to continue given this new paradigm. So I think that is where you kind of started looking at the profits and understanding that people were trying to justify profits by throwing in the growth rate of a lot of these companies and expecting that to continue. So they might say, well, the price to earnings ratio it might be this, and it might be very high compared to historical averages, but if you throw in the growth rate, it looks much more reasonable now. And that growth rate is going to continue at 25, 30% plus. And so there was just a lot of buy-in. This was really going to continue, and we saw a lot of the exuberance in those sectors. And what was interesting is, the insiders maybe saw a little bit more the reality perhaps, and there was a higher level of insider selling. And with that came greed. I mean, you saw whether it was Tyco, Enron, WorldCom, there was definitely some ethical questions that came out of this, and people obviously trying to really make good and maybe even get a little greedy and actually bend or break the law, depending on how you want to define that. So it definitely was a time where greed came into play. But if you look back at the fundamentals, the actual valuation measures, and tried to look at it very objectively, things were suggesting that there was trouble ahead and that the future returns, you were going to pay for it. And we definitely saw that, especially when we got into the 2000s. So I think definitely a lot of things that are different about 1999, and we can go to 2000 and kind of talk about, or more recently 2020, I guess, and talk about where we are now. So kind of that point, kind of where we are today, here's some other things to consider in terms of those differences. So as Dennis mentioned, in terms of technology and industrial, that revolution, we are seeing that being more in the deployment stage now, and kind of thinking about, the big difference I think right now from a background perspective, the economy was very, very strong, at least at that time in the 90s, the late 90s. Here, the economy is much more challenged. And so we're much more putting our stock with the authorities, right? The central banks in terms of low rates, buying securities, helping, stimulate the economies. And maybe we're shifting now more this year, particularly to the fiscal authorities, lower tax rates and just things that may help create this bridge to get through these uncertain times. And so, the backdrop is there's definitely some things happening, especially when you look abroad, that suggests that there's a lot of things to be excited about in terms of growing middle class and some of these technological things that are developing that could really spur growth beyond even what we're expecting. So I think there's much more positive kind of where we are in that stage. And then when you think about profits, we definitely it's tough right now. It's kind of looking through a kaleidoscope currently, trying to figure out where things are versus a telescope. But we do know that taxes are something that are out there that could reverse. We don't know for sure, but that's something to be on guard for, especially with an election year. And so that's something that we just want to think about as we go forward and how that kind of feeds back into profits. It would definitely be a little bit of a headwind, but once again, a lot of times there's more angst and concern than reality there, but definitely something to pay attention to. And then insider selling has been more modest. We've seen some, but I think it hasn't been anything to the level of the late 90s. And then kind of back to the authorities, the interest rate environment, the expectation is we're probably going to be in a very low interest rate environment, probably for at least a couple of years, maybe even longer. And so I think that's very favorable to financial assets and particularly stocks, more growth. Then you have these wild card items, especially China and just competition. And we do expect that to come back to the forefront. It already is now, but it kind of died down with some of the economic woes and kind of back to last year's, trade war, and the more focus is probably going to start shifting back because we're expecting they want to be the top dog just like we do, and there's going to be more competition there as we go forward. So we'll be probably having more and more discussion about China as we go forward in terms of just things to consider there. And then valuation metrics, once again, it's tough right now to assess, but I think as we look forward, we do think we're back to kind of JT's point earlier in terms of starting point, but we probably are a little bit above the historical averages in terms of the price to earnings and the valuation metrics. And so that does suggest to kind of temper expectations. And once again, I think we talked about some of the other asset classes, things we're trying to do to kind of make up for that. And it also could just be being more tactical, which does create more portfolio activity as we have these periods where the markets may be up and down, just trying to see if we can add value there as we go forward. But just looking at it from a baseline perspective, it's probably just saying expect more modest returns, at least over the next 3 to 5 years.
Okay, any other comments, PJ or JT, on today versus 1999?
Yes, I'm reminded of the adage, history doesn't repeat itself, but it does rhyme. So certainly there are a few stocks that resemble some of the 1999 worst practices, if you will. But by and large, some of those standout 5 companies are minting money right now. So, it's hard to step away too forcefully, but we do see that those kind of valuation metrics and perhaps the trajectory of those stock prices are unlikely to continue on a relative basis. So we want to be cautiously backing away from some of those outperformers.
Yep. Well, Morningstar recently came out with an update on Amazon valuation metrics and some other things, and it was one of the more nuanced research pieces that I've read for a while, where they acknowledged all the wonderful things going on at Amazon, but we're just scratching their head over how to justify current valuations.
And that's where it's hard for us. They're definitely a bit more in the old school valuation camp, definitely harder to stomach continuing to hold or add to some of those momentum names. But you want to participate, and we have participated meaningfully with them, even in this era of dramatic outperformance. So,
speaking of dramatic outperformance, although it seems to have waffled a little bit here in recent days, Tesla is a subject for a lot of our audience. Not that they actually want to buy it. Maybe they want to buy the car more than they want to buy the stock, but it has pretty much gone crazy in recent months. So anybody want to opine in on what's going on with Tesla?
nope.
And the only comment I'll make, obviously, I think it's been a big momentum play. I think it's been somewhat driven probably as a result of, again, the idea of a younger generation maybe getting into trading. You've seen a lot of discussion on Robinhood. I don't know if that can move the market that much. But again, what you're seeing with Tesla where it is I think some people trying to front run potentially it being added to the S&P 500. That's something that most people probably don't realize is that Tesla is not part of the S&P index. And so the expectation was it had to get to, or there's certain requirements for companies to be added, such as profitable quarters showing some solid earnings. And I think people anticipated that with this most recent earnings announcement that they would get there, and they did in terms of how they presented their earnings. A big portion of it was driven by some credits that they sold to the government, I believe. So I think the anticipation is that all these large index funds are going to have to buy Tesla at their next rebalance to add it to the portfolio. So that's also been driving it up. Is it sustainable? I'm not going to speak to what direction it goes from here. But again, it's definitely been a strong momentum play over the last couple of weeks.
Obviously, there's been a lot of skeptics. The technology is compelling, but a lot of skeptics on the stock side have sold Tesla short and made a lot of headlines about it. They have been very chagrined by those moves over recent months with this incredible trajectory. So the no tree grows to a sky comes to mind, grows to the sky. Again, compelling technology. Can the stock validate itself? We love these fascinating high growth stories. You have, a handful of examples over past history that capture a lot of mind space for investors, but they are clearly quite the exception. It's wonderful when they are wealth enhancing, but it's hard to put real money into it at these kind of valuations.
Yeah, well, we've had a number of our business leader clients who have said Elon Musk may be the Thomas Edison of our day, but they really don't like his management style or his leadership style on the business side. So we'll see which of those works out. Glenn, you had a comment?
Well, I was going to say, I think, in terms when you think about the stock outlook or allocation considerations, I think beyond the U.S. to international, kind of that consideration, I think the other big consideration, like JT started out with, was really that kind of growth to value, or just growth more to blend, I guess, where you're looking for just when are we going to see that strength in the technology in some of the growth areas subside or at least shift to other areas. And I think the pandemic obviously has accentuated technology, just given, technology's been able to continue moving forward. It hasn't been impacted as much as some of the more socially focused sectors. So, we had been trimming back just a little bit on the growth side, trying to neutralize, and candidly, we're a little bit early. But I think that's where when you start focusing on fundamentals and you realize, hey, sometimes these trends can play out a lot longer. But I think it's still a decision to shift more at some point, because this has been really strong. And that is the one similarity I think that JT mentioned was in PJ on those top 5 names. They continue to really carry the weight here. And so just another thing to consider as we go forward.
I think we have a good question about what about the so-called dividend aristocrats, so higher quality companies that tend to be dividend growers or dividend producers. And that's actually been a theme that we've kind of leaned into for a while. They have not been in favor in this momentum climate, so the more value names. But we do think, the ability to grow dividends, to have high quality balance sheet, to produce real income that investors can live out of is pretty compelling. And again, at present are at a significant valuation discount. So not something we're likely to move away from. and something that could return to favor in coming years. So they also tend to hold up a good bit better in those down cycle events. So they have some defensive characteristics that are attractive right now as well. So
yeah, we're getting increasing intelligence information from a variety of sources that many of those you call them old dividend aristocrats are retooling themselves, technology enabling themselves, which could be very helpful for them in the future. I don't think they're going to become a Facebook or a Google or a Microsoft, but they certainly have the ability to gain some tailwinds to their profitability and dividend growth through some of those trends.
I would say, Dennis, also, I think if we are expecting more modest returns, I think depending on what time period you look at, but over longer time periods, dividends may represent 30 to 40% or more of your total return. And so I think if we're expecting, modest returns, then you might want to lean in more to that dividend income component.
And obviously it varies portfolio to portfolio, but clients may recognize ETFs like the Vanguard Dividend Appreciation Exchange Traded Fund. They may recognize a Vanguard Equity Income Fund in many of our portfolios, and both of those capitalize on that sort of theme.
Yep, very good. So a related question is around what we talked about earlier on Operation Warp Speed and the pharma companies, and whether those are investable areas. And I think the short answer is probably not, because the margins, first of all, no company is going to try to gouge on their vaccines. In today's day and age, that would be suicide in terms of trying to gouge on a pandemic health crisis. And there's been a lot of speculation just this week, for example, on Pfizer, what kind of benefit they would get if they do prove out their vaccine, what kind of additions to their profits that could mean. And we've had some of our folks in the space say, focus on other things within healthcare that are non-COVID related. And that may be where some of those pharma companies work out. So again, right now, at least from our viewpoint, probably not a reason to try to overweight some of those stocks or that sector. Any other comments on that before we wrap up?
Just that it's too hard to handicap the horse race, even with the government kind of putting their thumb on the scale with some of the investments they're making. Which ones of those will turn out to be the optimal solution is something that only science is going to be able to answer.
Yep.
I think it'll be interesting to see if we have multiple choices there and which one do you choose and competing options as we get closer to that point.
Oh yeah, that could be a little bit of an issue if one particular vaccine has more side effects than another one, but we don't know it until 6 months from now. Okay, well, so lots of things to consider. We are done for the day. Reminder that we do record these, so you can go back, or if you want to share it with any other members of your family or others, you can forward that on our SFG YouTube channel. And so on behalf of JT, Glenn, PJ, Dennis Stearns, have a wonderful weekend. Hope you all stay safe. Bye.
Thanks all.